Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. My name is Matt Landon. I'm joined by Jordan Shinsky, and today we're talking about charitable giving. This is part 2, so if you haven't caught it, I'd tell you to take a step back, look at part 1. But here we're diving in, we're talking about gifting. We're talking about charitable gifting, ways to do it, and how to maximize that gifting return. Now, one thing you can do is tangible personal property. Now, if you're gifting tangible personal property, this is things like old clothing, household goods, vehicles. These are things that, as long as they're in good, used, working condition or better, under IRS tax rules, you can donate and you can get a deduction. Now, the key thing here is it has to relate to the charity's mission. So I'll give you an example. Salvation Army, they take in goods and they take in old clothes, they put them into their restores and they sell them and they gift them out in different ways. That's part of its mission. So that those old clothes would fall under that charity. Whereas if you have a church that maybe doesn't have any kind of a clothing store or any kind of like a food pantry, and you gift a bunch of food to the church, it may not fall under the same categories. So I think it's important with tangible personal property that you make sure it's part of the appropriate thing. A lot of charities will give guidance on this. This particularly comes into play with old furniture and things of that nature. So you might be cleaning out your parents' home if they've unfortunately passed away or if they've moved, and you want to make sure that you're getting the full benefit out of gifting that property. Now, that's for tangible personal property. What about maybe less tangible property?
Right. So there's different types of the way the property can be reported and what you can take advantage of on tax deductions. So the first aspect of it is going to be ordinary income property and short-term capital gains property. So think of the idea of owning a stock.
Yes.
There is a defined difference between short-term gains and long-term gain property. That difference is 1 year and 1 day. Mm-hmm. Anything prior to that 1 year and 1 day is identified as short-term property. Now, why is this important? It's because it can be reported differently. Long-term property is reported based on its fair market value of what it is worth today. Short-term property is only identified by its cost basis. So let's say that I make a purchase on a home for $100,000. And in 8 months' time, it is now worth $200,000 and I want to donate that home. I can't donate it and write off $200,000. I can write off, or I can report on my taxes a charitable contribution of $100,000 in value.
However, if you've held that home for 5 years and it went from $100,000 to $200,000, you can easily write that off the full value.
Right.
That's where the long-term versus short-term comes into play.
Right.
Same thing holds true for stocks. Now, something that I think is key with this is around losses. You've been talking about gains. Mm-hmm. Unfortunately, sometimes things go down in value. And so when you think about that, with a loss, you're only able to write off, whether it's short or long-term, the current value of that position. Meaning, let's say you buy a stock for $100 a share and it's currently only worth $65. Well, you can't write off the $100, you can only write off the $65. Mm-hmm. In this case, instead of donating that asset, you'd be better served by selling that position, realizing those losses, using them to offset gains elsewhere, and donating that $65 to that charity. So this is a case where you really want to understand the gains and the losses and the timeline between them in order to maximize that gift.
There's strategies involved.
There are.
And this is also, the conversation of this is where you really want to get your CPA involved as well.
Correct.
So ask your CPA about, hey, I have XYZ stock, or I have this property. What are my consequences? What are my advantages of deductibility if I were to donate it? And would then talk to a CFP and your advisor about what is the strategy to do so.
Now, this is also a case when we're thinking about estate planning. So when you're looking at your estate planning, you may have heard leave a certain percentage to the church or to a charity inside of your will. That may not be the best way to do it because of the step up in cost basis that your children would receive. Also, with the exemption of, for most of us, estate taxes, Right now, the current exemption being a little north of $24 million for a married couple, we look at it and say you're not really getting a tax savings there. Whereas that IRA account, if you were to leave that to your kids, they have to pay income taxes on it. A charity does not. So that's something where when we're thinking about gifting, both while you're living currently, but also from a legacy standpoint, we want to maximize the charitable gifting that you provide. So I'm not saying don't leave money to the church, but it may not be the best course of action to put it inside of a will. This is where, again, you want to work with your CPA, you want to work with your CFP, and you may want to work with your attorney to craft the appropriate legacy plan to realize your goals. There are some different accounts you can use along the way.
Right.
Let's hear it.
The most common one that people are going to want to take advantage of is what they refer to as a QCD, Qualified Charitable Distribution.
Excellent.
This is from, right? Okay, so this is from an IRA, some type of pre-tax vessel that the money has been in, and it takes advantage of at the point in which you need to begin taking RMDs, required minimum distributions. Now, there's a little bit of confusion there with that because they've been increasing the required minimum distribution age. It's now 73. But when it was initially set up to be 70 and a half, qualified charitable distributions synchronized with that age. So it allows you at that point of age 70 and a half and beyond to take a distribution that would satisfy your RMD and donate that to the church without the tax consequences of having to file it on your income in your taxes.
So it doesn't show up on your tax return, but you cannot take that as a secondary deduction.
Correct.
What you're doing is you're just offsetting that tax consequence that would have hit you.
Right.
Now, another option that you have along with the QCD is you can use what's called a donor advised fund. This is a fund that you can open that you can put proceeds into. You can put both appreciated stocks, you can put cash. In some cases, you can actually put vehicles and things of that nature. It gets a little tricky. You want to work through it the right way. But what happens is you can front-end load that gifting to maximize it in one tax year, and then you can decide at a later date the individual charities and how much you want to disperse. So you might put $50,000 into this fund at one time, and then you may gift it out over the next 4 or 5 years. While it's in that fund, it still has the opportunity to be invested, has the opportunity for gain. So that's another thing you can do. What's a CAT or a CRT?
Well, CAT is a cat, right?
That's right.
CRT, and this is probably one of the more complicated strategies. It is referred to as a charitable remainder trust. So let's say you want to take a larger value of money and you want to ultimately donate that to a charity, to your church, something of that nature, but you still need to receive income, you still need to receive money off of that. Then you would utilize a charitable remainder trust, and this is where the attorney gets involved in setting up the trust and everything of that nature, but you're able to define an annual income stream that would come off of that trust, and then ultimately upon your passing, the remaining of it ends up going to the charity in its entirety.
Now, I hope this has cleared a few things up for you. At the same time, you might have noticed I misspoke. I called it a CAT. It's a CRT, right? It's confusing. There's all of these abbreviations. There's all of these acronyms. There's all these different things that come into it. And this is why I think it's so important to work with a professional who's able to clear some of the fog. What I think is most important is for you to come in with an idea of what you would like to accomplish. The role of the professional, be it your financial advisor, your tax preparer, and so on, is to help realize that goal and help find that path and guide you towards the appropriate way to do it. That's what we here at Semmax are so honored and privileged to be able to do. I hope before you do that charitable giving, you reach out to us and we can maximize that gifting for you. That said, on behalf of Jordan, myself, and the whole team at Semmax, we hope you have a wonderful day and thanks for watching.